Today, we're diving into Alibaba's latest earnings and what they mean for the future of the company, especially in AI and cloud computing. Alibaba reported its FY Q3 2025 results, covering October to December 2024, and overall they were solid. Revenue came in at RMB 280.2 billion, up 8% year-over-year, right in line with consensus. Non-GAAP net income was RMB 51.1 billion, up 6%, beating expectations by 7%. Let's break it down. Taobao and Tmall grew 5% year-over-year. CMR, or customer management revenue, accelerated to 9% growth, up from just 2% the prior quarter. Cloud revenue returned to double-digit growth, hitting 13%, a big deal given recent sluggishness in that segment. International commerce was up 32%, and local services gained 12%, both slightly above expectations. Logistics fell 1%, and digital media and entertainment rose 8%, both weaker than anticipated. Now the big headline from this quarter? Cloud is making a comeback, and it's being driven by AI. Alibaba's cloud business had been stuck in low single-digit growth, but Q3 marked a clear inflection point. They hit 13% YoY growth, and projections for Q4 are even stronger, up to 19% growth. What's driving this? A massive surge in demand for AI inference services. In fact, Alibaba said its CapEx over the next 3 years will surpass the total spent in the last 10. That's more than RMB 300 billion in CapEx from 2025 to 2027, or about RMB 100 billion per year. That's over 13 billion annually. Why so aggressive? Well, Alibaba is the largest AI infrastructure provider in China. Customers can use both DeepSeek and Alibaba's in-house Qwen 2.5 LLM directly on AliCloud. And thanks to a new partnership with Apple, iPhone users in China are also expected to drive more demand for Alibaba Cloud. AliCloud is best positioned to capitalize on surging demand for AI applications. The rapidly falling model training and inference costs are likely to drive an explosion in AI application creation. AliCloud, with 28% IaaS plus PaaS market share, is the largest public cloud service provider in China. Qwen is the largest open-source foundation model in the country, and it's expected to lead the development of business-facing AI applications. AliCloud is also the chosen partner for Apple Intelligence in China. We expect AliCloud to re-accelerate to a 20% plus 3-year revenue CAGR with margins staying stable or rising. Adjusted EBITDA margins could grow from the current 9% to double digits in the long run. Based on external revenue, AliCloud is valued at approximately $94 billion, which accounts for around 25% of Alibaba's total market cap. It's not just the cloud that's improving. Domestic e-commerce, which had been struggling, is starting to regain momentum. Taobao and Tmall are stabilizing, and the overseas commerce segment is growing fast while narrowing its losses. Analysts expect those losses to shrink significantly in 2025. Taobao Tmall Group is expected to return to positive profit growth in FY26. CMR is projected to grow at a 5 to 6% CAGR over the next 3 years, supported by 3 to 4% GMV growth and gradual improvements in take rate. That includes the introduction of a 0.6% technology service fee and more efficient advertising. As revenue grows and investment needs moderate, margins are expected to stabilize in FY26. International retail e-commerce is also a bright spot, with expected 20% CAGR over the next 3 years. AliExpress is deepening user penetration in its existing markets, and Trendyol is expanding geographically. New sourcing strategies like local fulfillment through semi-consignment models are helping broaden SKU variety and boost purchase frequency. ADIC, Alibaba's international commerce unit, aims to turn a profit as early as Q1 FY26. Valuation-wise, Alibaba's stock still trades at relatively low multiples. Add in the ongoing shareholder return initiatives, including buybacks, and the setup looks increasingly favorable for investors. From a broader market perspective, the focus right now is on Alibaba's elevated CapEx plans and whether they'll generate strong returns. The stock has outperformed, up 66% year-to-date versus the HS Tech Index's 35%. But investors want to know, Is all this AI investment going to pay off? In our view, yes. We estimate around 80% of Alibaba's capex is going directly into AI servers, the backbone of inference and training capacity. Even with chip supply constraints, Alibaba's early and aggressive investments, plus an improving domestic chip supply chain, should keep them in the lead. Our estimates suggest that the AI infrastructure Alibaba deployed in the past year alone could generate RMB 30 billion in annualized AI revenue once it fully ramps up. Combine that with continued high single-digit growth in public cloud, which still makes up over 90% of Alibaba Cloud revenue, and we're looking at a potential 25% growth rate for the cloud business over the next 2 years. On the margin front, Alibaba's AI workloads are expected to carry EBITDA margins between 65 to 70% and EBIT margins around 20 to 25%. That's significantly higher than their legacy public cloud business. As investors increasingly shift their focus to EBITDA in asset-heavy segments like cloud, this could help reshape Alibaba's margin story. And let's not forget, Alibaba Cloud is still by far the largest public cloud provider in China, with a scale roughly double that of Tencent Cloud or Huawei Cloud. That scale advantage, combined with leading AI infrastructure, positions them well. On the AI model side, investor attention is moving from infrastructure to applications, things like AI agents and user-facing apps. Alibaba launched QBUQ32B, revamped its Quark AI app, and is partnering with Manus. These moves follow similar initiatives from ByteDance and Tencent, showing how fast the Chinese AI ecosystem is evolving. We're currently modeling 19% revenue growth for Alibaba Cloud in Q1 2025. For FY26 and FY27, we've raised our forecasts to 24% and 26% growth, respectively, as we see high demand for AI training and sustained pricing power. We've also adjusted our EBIT margin assumptions slightly, now expecting 11.9% and 12.0% for FY26 and FY27, up from 9.7% in FY25. Net income forecasts for FY26 are up modestly, while FY27 has been trimmed slightly due to depreciation effects from high capex. So here's the bottom line. Alibaba is going all in on AI, and the early results are promising. Cloud is reaccelerating. Domestic e-commerce is stabilizing. Overseas segments are growing fast. And with a cheap valuation and active buyback program, the stock has room to run. This may be the time to take a closer look at Alibaba. If you found this breakdown helpful, hit like, subscribe, and let me know in the comments what part of Alibaba's business you're watching most closely. See you next time.